America live stream the meeting. The meeting is now streaming live on Facebook. All right, Chris, you gonna join me in a rendition of Money Monday is starting soon?
Yes, let's do it.
Money Monday is starting soon. Money Monday is starting
soon. Money Monday is starting soon.
It's tough to sing at the same time over Zoom.
It is. I've done that with trying to sing happy birthday to people from a few different devices at the same time. It's usually kind of rough.
Money Monday is starting soon. And shared. All right. And now, there we go. All right. Fantastic. Hi, everyone. Thank you so much for joining us. I'm Henry. I'm your friend in finance. And today we're joined by the amazing Chris Tanner. And this is where I would have a little air horn that would go.
Hi, everyone. Thank you, Henry.
Thanks for joining us today, Chris. I'm pretty excited about what we're going to be talking about today. Thank you all for joining us today, too. This is going to be a pretty exciting, I think I'm pretty excited, at least, Chris, because this is a really easy to implement financial strategy. Do I remember right that it's something like this is one of the only strategies that the IRS, that like the SEC or the IRS is like, no, that's like proven, mathematically proven to work?
Yes. And as the regulators, they're not going to get behind all that many of the strategies out there to say, yes, this has a stamp of approval, but this is one of them.
Yeah. So that means that it's good. The math is behind it, and we're excited to show that with you all today. It's called dollar cost averaging. But before we start, we got a lot of really exciting things happening here at Plan and Act that we want to share with you. This was the first thing that we're going to talk about up there. It's for our clients. We're actually starting up a book club starting later this month. You should be getting an email this week that's got all the registration information in there, including what book we're reading. I'm pretty excited about it. This is an idea that clients had they came to us and they were like, this is great, but we want to be able to learn together. Me, Chris, Bob, we're always recommending books to everybody. So it was just a simple thing of, oh, you want to learn together more? Well, why don't we do a book club, since we're always recommending all these books on the psychology of money, on investment strategies and all that. Why don't we read all that together, and that way we can learn together and grow together. So I'm pretty excited about that. So again, clients, you should be getting an email this week. If you're not a client yet, come on and join us, because this is going to be something that's going to be really good for everybody involved. It's kind of there's so much information out there that knowing that these are books that are recommended by Bob, a certified financial planner. It helps narrow down the noise that's out there on the internet, because the internet's just chock full of stuff. You don't know who's actually good. Bob's a certified financial planner. That's who we get these books recommended from. And so that way you know that these books are good, they're effective, and they're going to actually be able to help people out in their lives. So I'm pretty excited about that. I am a bookworm too, though.
He definitely is. I feel like nobody reads more books, or at least not as quickly as Henry. So, and don't worry, for those that are going to be taking part in it, we're both involved, and we aren't going to be, doing one book per week or for 3 days, as is Henry's personal rate of reading. It'll be spread out over a chunk of the summer.
Yeah, so I'm very excited to see a lot of you there. Chris and I are going to be leading those meetings, and we've already read this book, but it's going to be a really great way to just kind of refresh our minds with some really good knowledge. Speaking of things that Chris and I are going to be leading, we're actually not going to have a Money Monday next week, because we have this is another thing for our clients, we have our monthly mastermind, which I'm excited for every single month. It's like, it's my favorite day of the month, because we all come together, we support each other, we talk about challenges we've had. We answer any questions people have encountered during the month. And it's just, if you're one of our clients who joined us for one of those, thank you so much for joining us. Because just the energy that I come out of from those meetings is just like my heart feels so full. I don't know about you, Chris, but I just it feels so good. And I know
that's exactly right.
If we could, yeah, I know we've been asking if we could do more than one a month. But I think it's like ice cream. You don't want to have it too much because every once a month it hits the sweet spot. So I'm very excited for next week. Clients, you're going to be getting an email about that this week as well. Come join us for that as well because it's always a good time. If you don't want to miss out on any of these things, for instance, we actually wrote an article about dollar cost averaging last month, and if you don't want to miss out on anything like that, it was a very helpful article. Sign up for our newsletter. The link is in the description, so sign up for that. You're gonna get updates about new things we have to offer, blog posts, other types of content, video content that we're offering, free webinars. Make sure you're keeping up to date with all that. Sign up for our newsletter. And I will add one last housekeeping thing. If you're just joining us for the first time, be sure to hit the like button for our Facebook page. That helps us get the word out there. We believe in financial education for everybody. And just by hitting the like button, you're helping us get that message across. So thank you so much to everybody who's joining us who has liked us already. And if you haven't, go ahead and give us a like. Thank you so much. And now, without further ado, drum roll, because we're going to talk about dollar cost averaging. So I'm going to erase the starting soon since we have actually started. So, Chris, dollar cost averaging. I guess a good place to start would be the why is it important? What are some of the problems that people face if they just jump into investing in stocks without having a strategy like dollar cost averaging?
So what I think that the biggest challenge is that markets go up and down, and we often think that we know better than the market or than everybody else involved in the market, and that we can predict when it's going to go up, when it's going to go down, and make money on those variations. And take it from us as professionals in the industry, as financial planners, that we can't predict where the market is going day to day. And so you're much more likely to get burned than in any way, helped by trying to individually make bets on a day-to-day basis. And also you'll experience a lot more stress in your life doing that.
Yeah. One of the jumping off of one of the things you said there, because I've had a lot of people come up to me. You might know some people who talk like this, where they're like, "Oh, I've made a lot of money recently on the stock market by picking stocks." Right now, everybody's making money off of stocks. Everybody's going up. There's a Warren Buffett quote. Don't know who Warren Buffett is. He's a famous investor, very, very good investor. He's got a famous quote where he says, when the tide's rising, everybody's boat goes up, like we're seeing right now. But when the tide goes down, that's when you can see who is swimming naked. Or that's when the market as a whole is going to go down, which it will eventually, because it's a cyclical thing. Eventually the market's going to go down again. That's when you're going to see who is out there placing these really risky bets. And I'm saying bets on purpose because it is like gambling. And so at that point, are you going to be the person who's going to be going down here, or are you going to be the person who the whole market is going down and you just lose a little bit less? You lose less than everybody else. There's another really good book that we read called The Psychology of Money that talks about how the goal isn't to. There's a difference between getting rich and staying rich. And so if you want to stay rich, you can't be going up and down with the market like everybody else is going to. So that's where dollar cost averaging comes in. And also, I want to just give a major shout out to, and I want to give this is a testament to how smart Chris is. We talked about what we were going to be discussing today, but we haven't like rehearsed it or anything. Everything you're hearing is off the cuff. My question to Chris was completely off the cuff, and he rolled with it. And that's just a testament to how much Chris knows, just off the top of his head. He's like, yeah, that's the depth of knowledge that Chris has. So if you want to talk to somebody really knowledgeable about investments, make sure you guys talk to Chris. He's fantastic. So that's the why of dollar cost averaging. The market is going to be doing this, going up and down, up and down, up and down. And what we want to do is keep you from going down so much, because something that I've told a lot of people is, if your money's going up and down, up and down, and up and down, if you still are, have a full-time job, if the market crashes, there's a good chance that your employment at that point is going to be in jeopardy too. And so just when you need that money most, you might need to tap into that money most. That's when you're going to be right down here, and your assets are actually going to be at their lowest ebb. So that's why it's important to have the strategies like dollar cost averaging in place to help protect you against these times in the market.
Henry, I want to share one more scenario. Part of the why, because I think we talked about one half of it, which is going in and thinking that you'll be able to like predict the ins and outs. A lot of us have heard the wisdom of buy low, sell high, meaning buy it when it's cheap, sell it when it's appreciated, when it's worth more, and you can get a profit that way. People that try to market time end up doing that maybe sometimes, but they end up also buying high, selling low a lot too, because of that volatility, because of how unpredictable it is. Now, second scenario is if you don't have a plan at all, or are just afraid of the stock market because of that variation. And so you sit on the sidelines, just in cash. You're like, okay, my checking account gives me 0.01%. At least that's not negative. And that's, I understand that, especially if you've lived through periods like the 2008, a great financial crash, or the dot-com boom and bust, or if what happened with COVID in 2020 really scared you. That's a 33% drop in 1 month in the big market indexes. So dollar cost averaging is a strategy that addresses, it's an alternative to both of those extremes, neither of which is the most optimal for growing your wealth in the long run. And I think just with that image that you have on the board behind you, Henry, those waves up and downs, over the long term, they are gradually moving higher. That's why you don't want to be sitting on the sidelines forever. Because if you did get all your cash out of the market after COVID, the big drop, the 33% drop, you would have missed the more than 70% growth since that market bottom. It's been more than 70 in more than a year, but at the 1 year mark, it had recovered over 70%. So we're showing this strategy as something that no matter where you are on that spectrum, this is something that brings peace of mind, and over the long term really pays off.
Absolutely, yeah. And thanks for pointing out that this was a complete accident, but I'm going to say I did it on purpose, that I did actually draw it over the long term, even with the ups and downs. It is slightly going up over the long term. So that's the importance of being invested in the stock market. I'm going to just say one more thing, and then we can actually talk about the strategy. I don't know, Chris, if you've seen the meme out there about how, like, if you earned like $1,000 a week for like 100 years, you still wouldn't be a billionaire. I think that I want to say that it was something like that.
No, I haven't seen that.
Yeah, it was something like that. I don't think those are the exact numbers. And I read that, and to me, and I realized that it's because people, and this is actually an article that we published just today about compound growth, and that's the importance of investing, and investing soon, investing now. because people think in terms of linear growth, straight lines, right? But with investing, you actually got to think in terms of compound growth, which the graph looks like that. And for people, it's really hard to see that sudden uptick. So that's something to just bear in mind. And it is about the importance of investing. It can be scary, but that's why we have strategies like dollar cost averaging to take care of it, because it is important to be invested in the market, so that way you're making these gains. I do see we have a comment. I'm going to step away from the camera for a little bit just so I can read it. Oh, that's Brian. Brian says, let's get that email. He also says, buy, hold, reinvest dividends, keep adding in until you can live off the dividends. That's the philosophy. That's pretty much it, Brian. And today we're going to be that's pretty much exactly it. And today we're going to be talking about what that adding into it looks like over the long term. So, and I know Brian just read Tony Robbins' Unshakable. If I'm not mistaken, I think it was Unshakable. So I think that Tony Robbins talked about dollar cost averaging in Unshakable as well. So let's break it down. Dollar cost averaging.
Yeah, what is it, Henry? Tell us.
Dollar cost averaging. So we talk about, oh gosh, this handwriting. I'm working on it. We talk about the importance of diversifying. You don't put all your eggs in one basket. You don't want to put all your eggs in a single stock, like I've seen a lot of people do. You also don't want to put all your eggs into just one type of asset. So you don't want to just own stocks. You also want to own bonds. You also want to own real estate. You want to diversify as much as possible. The best way that I can think to describe dollar cost averaging is you're diversifying over time. You're buying it at regularly at different points in time, and that ends up using the volatility of the stock market, that up and down, in your favor, because you are buying it at different points there. And so it ends up averaging out so that you're not exposed to all of that volatility. It lowers the volatility, and we're going to show you some numbers soon to show you how it actually ends up helping you come out ahead because of the volatility. So I think the best way that I know to describe dollar cost averaging: diversifying over time, using time to your advantage. How does that work with you, Chris?
That's a great way to describe it. Yeah.
Let me erase this here then. So the way that what dollar cost averaging actually looks like is, let's say you want to invest. We'll make it some small numbers, make it easy. Let's say $1,000.
Mm-hmm.
You want to invest $1,000. Now you have some choices. You could invest. Actually, we were going to use those numbers from that article that I wrote. So let's
say it's $300. Let's use that number.
Completely random number that we pulled out of the air. Let's say you got $300 that you want to invest. You have some options of what to do with the money. You could invest. You could just one of the options that we talked about is just keep it in cash. So cash, $300. You could just go okay, I want to buy $300 in an S&P, or just like a stock index fund. S&P, for those who don't know, is basically a measurement of how the 500 biggest companies are doing stock-wise in the US. So you could say, okay, I'm going to go buy $300 worth of the S&P 500, or just right away. Or what we're going to be showing you here is dollar cost averaging. Let's say you're buying into that same S&P fund, but instead of buying it all right away, you would buy $100, that's a zero, $100 one month, $100 the next month, and $100 on that third month. So you see, that's what we mean by diversifying over time. It's the same $300, but instead of buying it all at once, you're buying it over a span of a few months. Now, this could be a few months. This could be like once every quarter you're putting this money aside. You could do it at any span
Every
of time.
paycheck? That's every 2 weeks for some people. Yeah.
Exactly. So long, the goal is to keep it regular. So $100 every month. Now, what's going to happen to the money during that time? At the end of the 3 months, the cash is going to stay $300.
You know, it might be 303 cents. If you're getting that 0.1%, you might have a couple pennies of credit.
And 3 cents. That's true. That's very true. $300.03. If you bought, let's say, a share of the S&P 500 in that first share cost. Let's say in that first month, it was $10. So per share. I'm going to end up having to erase some of these so I can I can write it a little bit more clearly. So in this scenario, just buying the index fund, you get 30 shares. Let's say here here we got 10 shares. So DCA. This row is going to be the number of shares that were bought this month. So you bought 10 shares here. What was in that second month? What should the price per share be?
$8 if it goes down.
Yeah. Let's assume that the market goes down. But this is even probably not a great thing that's happening in the market right there. This is going to be a very volatile few months, just for because that's like a 20% loss there in 1 month for the S&P 500. So at this point, $8 buying $100 worth of shares, that will come out to
12.5 shares is what you get then.
I was almost there. So close. 12 and a half.
I know you had it. Didn't mean to cut you off.
You're good. I'm glad that you're there to read it out to me. And then if we did $8 here, let's assume the market goes back up and makes a little bit of a gain on that third month. So was it $12?
$12, yeah. Let's do that.
$12 per share. And that means that if you're buying it with dollar cost averaging on that third month, you're buying all right,
8 1/3.
That was going to go in.
It's less than
Yeah. So what do we have at the end of all this? If you're buying it, these shares using dollar cost averaging, at the end you actually have 30.8. 30.83333.
Yeah.
30.833 repeating shares. So 30.83 shares, which is more shares than we purchased here in just buying it all flat out, buying it all at once. Why did that happen? Because when the stock market went down by 20%, we were able to buy those shares at some of those shares at a discount, which lowered what's called the cost basis. Basically, the average cost of each share went down. And even though it went back up again, we used that when we just by the system we're creating, taking all emotion out of it, we were able to do that buying low and selling high with some of the money. So you can see that we're actually ahead from where we would have been if we had just bought the shares flat out. If we actually convert this into money, the difference is even starker. 30 times, that'd be $360, I think.
Yep.
$360. Our investment from the buying it flat out became 360. And how much? And that with those thirds are
yeah,
gonna get me.
That comes out to 369.9 dollars with dollar cost averaging is what you have at the end. And how we get that for those watching is the number of shares times that final share price, because they're all ending up at the same price. But since there's more shares multiplied by it, that's how we get the 369.
So 12 times 30 and 12 times 30.833. This is only after 3 months, only after doing dollar cost averaging, only after following that, diversifying over time 3 times. Over the long haul, the stock market's going to continue doing more of these ups and downs and ups and downs. And so you're going to see the difference over the long haul become even bigger and bigger and bigger. And as you get more shares down here, then the total final amount is going to grow here. And the other really good thing about this is that because you hold more shares, if you have a fund that pays dividends, your shares are actually you have more shares, so you're going to get more in dividends when they're paying out dividends as well, and that's going to make this difference grow even more over time. So that's something that that's something that's not even seen on the price of the actual stock price if you're looking it up, and that's one of the things that makes dollar cost averaging so powerful. And it's something that people can do, that you can do right now. If you've never thought about finances in your life, all you got to do is start a brokerage account, and instead of going in and buying meme stocks and all these other things that you hear about on the internet, that there's a lot of pump and dump going on right now. People talking up specific stocks and things like that. Instead of doing that, go get an index fund with like an S&P 500 index fund, a low cost index fund like that. Or you might see some that say like a total market index fund or mutual fund, something like that. And you can just buy and you don't need what is, I forget, I meant to look up Amazon, what Amazon's share price is, because that's like thousands of dollars to buy a single share of Amazon. You don't need that with index funds. You can do like $10, like Chris said, $10 a week, $10 every paycheck. That's all you need to do per paycheck. That's all you need to do. And over time, that's just going to become an incredible amount of shares that you're going to own of that index fund. And that's going to just compound and compound on itself. And again, if you do need help visualizing the compounding, go to planenact.com/blog, because we got a new article that went up today that talks all about the wonder and power of compounding growth, which we will probably also do a video on at some point in the near future.
Yep.
So, dollar cost averaging. Chris, what have I missed?
Well, I think that was an awesome explanation of it. I have nothing to add on the what and the how. I do want to just mention though that a lot of we talked about individuals not necessarily having a strategy for how they invest and trying to time the market. A lot of advisors, their value proposition is being able to time the market. And I think, our stance on that is just that over the long term, you can't do that. This is something you can implement yourself without paying a lot in fees for somebody to actively manage and stock pick for you. And over the long term, this is a strategy that really, that excels, ends up ahead. And another thing that I'll just say that a lot of advisors will sell, what we'll just provide as their services, is taking this strategy, dollar cost averaging, but using it for retired folks. Once their clients are in retirement and are spending down their portfolio, they're taking money out of the stock market and out of their investments to live off of. And one rule of thumb in the industry is the 4% rule. We don't have to go into that in detail, but that's often applied to select a specific dollar amount that will be sold out of your investments every month or every year. And that just keeps on going. And so that may sound to you just like dollar cost averaging going in, you're buying a certain amount of dollars every month. What a lot of advisors do is they will sell a certain amount of dollars every month to give you that income, because in retirement you need a consistent income stream to replace the income you used to have from work. However, what a lot of people don't know, a lot of advisors and professionals don't know, is that the same force which made you money from dollar cost averaging on the way in when you were using it to invest actually works against you when you're selling. It works against you when you're in retirement, because those same ups and downs cause you to sell high and buy low. No, that's wrong. Cause you to sell low and buy when it's high.
Yeah. Just to visualize it, we have this curve here again. With when you're growing your wealth, dollar cost averaging helps you buy more shares when we're in these tranches, and buy fewer shares when we're up here. When we're up here, but if you're doing it in reverse, you're selling more shares when you're down there, and you're selling less shares when it's actually high. So let that be the visualization of, like, let's say you had 100 shares. Let's say you had 100 shares of something. When you're at the lowest and you had to sell this, when you're at lowest, the market goes down. You might have to sell 20 of those shares to hit the income that you need, because you're taking a certain dollar amount out. As opposed to when it's up high here, you might only need to sell like 10 or something like that. But by that point, the damage has already been done. You're already down to 80, and then it's bad news bears. Basically, is what it comes out to. But again, when you're growing your wealth, this is the way to go. This is dollar cost averaging is going to help you really grow that wealth.
Thank you for that visualization, Henry. That was right on, and I think helped.
I think I see it.
Demonstrate it.
Let's see. Oh, somebody else in messages. I got to minimize that. The loan amount large sums once or twice a year instead of in small amounts equal to the same large sums consistently over time. Those take advantage of potential dips in the market and you get more bang for your buck. Yes, Brian, you're getting it. And I also want to say, if you have a 401k, this is one of the things that makes 401ks offered through your employer so powerful, is because, like Chris said, dollar cost averaging can work with just a little bit from your paycheck each period. So you're already, if you're part of that 401k and you have like a certain percentage contribution each paycheck, you're already doing dollar cost averaging. So that already helps you get ahead. So if you're watching this and you haven't taken advantage of an employer 401k, take advantage of the employer 401k. It's going to help you out in the long run. I know it's scary. 401ks can be scary for people sometimes, but if you need more help understanding why 401ks can be amazing. So call Chris or me and we'll walk you through your employer's 401k so you can see all the advantages that are hidden in there, one of which is built-in dollar cost average. Boom. Making connections to the real world all the time.
I love it.
Thank you, Chris, and thank you, Chris, for pointing out that, because this is something that I tend to forget sometimes too, that 4% rule, especially if you're watching this and you're getting close to retirement, you might be hearing people talk about that 4% rule, and this might be something to re-examine. Come talk to me or Chris. Go talk to Bob. We can help you, walk you through what is actually going to be best for you as you're entering retirement, because there's definitely a lot of options as you're getting ready for that, and it's a very exciting time. So we would love to be there to support you through that. Chris, is there anything that we've forgotten to talk about today?
I think we've really hit on everything. You started with those great announcements up front of what's coming up, our client events, what's available to non-client people that are just getting interested with the newsletter. So I think we've done it. This is it.
Fantastic. Awesome. Thank you all so much for joining us. If you're interested in because this investing is scary and finances carry a lot of emotions. So if you are thinking about investing and you have questions about what is an index fund, what's a good portfolio allocation for me? There's a lot of confusion out there. Talk to me, talk to Chris. We'll walk you through it, and that way you can get set up in a way that's going to protect you from these points and help you really take advantage of these points in the stock market. We're here to support you. We believe in financial education. If you think this video would be helpful for anybody else, give it a share. Go ahead and share this on your Facebook page. Send this in a message to them. I think that this kind of information. I will say that one more thing. I've heard a lot of people talking about how I wish that finances were taught more in school. And I've heard a lot of people talking about that. And then I go, oh, well, there's these books you can read, or there's these videos you can watch. And then people go, oh, no, I don't mean that. So you can be a positive influence in somebody's life by going, hey, I know finances can be confusing. Here's a strategy so you don't walk in blind into investing. It's a really short video by some people who really care. Both Chris and I, we're not super far removed from regular people. We're still living regular lives, and we're not uber wealthy or anything. So that we care about you, and we've been there. So we care about you. We want people to do better, and we think this kind of knowledge is going to be the real thing that's going to go out there and really turn people's lives around. So go ahead, share this with your friends, with your family and your loved ones. This is important content. This can change a life. So thank you for joining us here today. Once again, I'm Chris. I'm Henry.
And I'm Chris. Nice.
I hope you all have a fantastic week. And I can't wait to see all our clients at our monthly mastermind, and get in touch with us soon. We're looking forward to hearing from you. Bye, everybody.
Bye.
Next time, Chris, I'm going to have to make you the host so you can end the meeting, and then we don't have this awkward little last bit that everybody can hear on Facebook.